people, this is Dr. Wang here recording. In this video, I'm going to talk about the analysis of financial statements. And this is from your textbook chapter 3. In the previous chapter, the basics of financial statements, we learned how to construct balance sheet, income statement, and the statement of cash flows. And we learned the intercorrelation between the numbers in the statements. And in this chapter, we're going to analyze those numbers, construct the ratios, and then make some decisions based on those ratios. And here are the topics covered in this chapter. So the first topic is the ratio analysis, and there are in total 5 different ratio categories. The goal of a ratio analysis is to use the ratio and make comparisons. You can either compare the company by itself to see whether we have beat our historical record, and we can also compare with other companies to see if our ratios beat theirs. The ratio can also be used investors, for example, the lenders or like a bank or some corporate bond buyers would look at a company's liquidity ratios and debt ratios to see if the company is risky or not. And the stockholders can also look at the ratios to see the future cash flows generated by its operations. And definitely the insiders, like the managers, can use the ratios to identify the weaknesses and the strengths of the company. The first category of the ratios is called liquidity ratios. And liquidity ratios measure firm's ability to meet its short-term obligations. Well, the ability is measured by the level of current assets, and we prefer our assets to be liquid. The most liquid asset is cash, and also some other liquid assets would be accounts receivable, short-term investments, and so on. And definitely, these assets are more liquid than buildings or machineries or land, because the later ones would be very hard to sell in a short time period. The short-term obligations would insert some pressure on firms' operations. If you have too much debt, then you are obligated to pay the interest back plus principal. Then you need enough capital to maintain the debt repayment ability. And the liabilities here could be the accounts payable, accruals, which also means the unpaid bills, wages, and utilities, and also unearned revenues. That could be notes payable and other securities. Well, there is a difference between liabilities and the debt. For liabilities, there's no interest generated. If you have a $10,000 accounts payable, then when still, you pay $10,000. However, for debt, either in notes, bills, or any other securities, there would be interest generated. If you have a $10,000 notes payable, then you will need to pay interest in addition to the $10,000 notes payable. And then if we take a look at the major liquidity ratios, we know net working capital, as I mentioned in our previous chapter, in the topic of a free cash flow. It is current assets minus current liabilities. And for different sizes of companies, the net working capital could be in different magnitude. Some companies could have millions of dollars of net working capital, and it's still not really liquid. And some small companies, well, they only have thousands of net working capital, but they could be very liquid. So that comes to this ratio called a current ratio, where we use the current assets divided by or scaled by the current liabilities. That takes away the magnitude effect. So the current ratio could be anywhere from 0.2 to 3.5. That's a normal range for a current ratio. Definitely we want the current assets to be greater than current liabilities to maintain sufficient liquidity. And another liquidity ratio here is called a quick ratio. It is a little different from current ratio because we exclude inventory from the current assets. And you know that inventory is not quick when you convert it to cash. You have to sell off the inventory, and that could take months to do it. And if you want to convert to account receivables, that could be easier. So when we exclude inventory from current assets, then we call it quick ratios. And the cash ratios, we use the most liquid assets cash as the numerator. The second category is called assets management ratio. That measures how efficiently do the managers manage the team or utilize the assets. What are the assets utilized for? It's for generating sales. So it also tells you how much does the firm have tied up its assets for each dollar of sales. And if you look at the efficiency ratios or assets turnover ratios, the top one is called a total assets turnover ratio, which is the sales over total assets. And our goal is to maintain a high turnover ratio here because we want to generate as many sales as possible while holding a limited amount of total assets. And that is high efficiency. And a worst case is you don't have much sales, but you have too much total assets to maintain. And that's not quite efficient. Another turnover ratio is called inventory turnover ratio. You can use the sales divided by the inventory. And in some other cases, you can use a cost of goods sold divided by the inventory. It depends on whether the inventory is the raw materials. If it's raw materials, you use the cost of goods sold. If the inventory is the final products, you're going to use it to divide the sales. And another ratio here is called a receivables turnover ratio. You're going to use the sales divided by accounts receivable. So each time you make a revenue and your payment is on credit, which means you do not get paid in cash upfront. Instead, you will get accounts receivable and you will collect your money in a later period. And based on the inventory turnover ratio above, you can have the day sales in inventory ratio, which is the number of days in a year, 365, divided by inventory turnover. Also tells you how long does it take to replace your inventory once. For example, if you are running a car dealership, and in the simplest case, you only have one parking lot just for one car for your entire inventory. Okay, and if you sell 2 cars during the whole year, then your inventory got replaced twice during the year. So that takes on average 182.5 days to replace your inventory once. So that is inventory turnover and day sales in inventory ratio. And likewise, you can derive this average collection period, which is the number of days in a year divided by receivable turnover. For example, if you are a divorce lawyer, after you render your service, you will bill your client. Let's say throughout the year, you always maintain $2,000 worth of accounts receivable. This account receivable will be outstanding and collected, then outstanding again and collected. If you have $10,000 worth of services delivered divided by the $2,000 of outstanding receivable, then your accounts receivable turnover would be 5. So that means you would outstand and collect your receivable 5 times. And on average, that is 73 days. And I can skip this textbook examples because we're going to do that in your Excel project. And this is your second question of assignment 1. Another ratio is called a debt management ratio, and that tells you whether the firm has too much debt and whether the firm's earnings meet its interest payment. All right, as I said, these ratios will be practiced in the Excel project, but I do want to mention here is for the debt ratio, you can either use the earnings, which is an item from income statement divided by the interest expense. So you want the earnings to be sufficiently large to cover the interest expense, which you want it to be limited. And also you can have the debt ratio. So the debt ratio is from the balance sheet, not income statement as the previous one. So the total debt ratio divided by the total assets is your total debt ratio. And you also want the total debt ratio to be reasonably low to avoid too much financial distress. You also have this profitability ratios. It's about telling you the rate of return for your operation and for your investment. And you can have this net profit margin, which use net income divided by sales. You can also have operating profit margin, which is your operating income or earnings before interest and taxes divided by sales. And definitely you want these margins to be as high as possible. And another important profit ratio is called a gross profit margin, which you're going to use sales minus cost of goods sold. This is a variable cost, and this number increase according to the number of units you sell, just like the sales would increase if you have more units sold. What is special about this gross profit margin is it can be measured at the firm level, at the accumulated level for the entire company for the whole year. For a company like McDonald's with 1.5 million employees across the world. And this ratio can also be used at the per product level. Let's say McDonald's produce a Big Mac, and we can calculate the gross profit margin for each burger, not just for the entire company for the entire year, but for each single product. So just a side note, if you are in the fast food business, you probably know that the gross profit margin for a hamburger is around 50%. So that means if you sell a hamburger for $2, then the cost of goods sold or the variable cost would be $1. So what kind of product in this industry would make higher margin? It would be the ice cream, the soda, and the gross profit margin usually is 90%. So that means for each dollar of ice cream or soda you sold, the cost is only 10 cents. So you make a 90 cents profit. You also have this ratio called basic earning power. You gotta use the operating profit or EBIT divided by total assets. And again, you want such a profit ratio to be high as possible. And you also have this return on assets, which use net income as the numerator and the total assets as the denominator. You also have a ROE here, which is a return on equity. The denominator here is changed to common equity compared to the ROA with the total assets as the denominator. If you are a stock investor, then you would care ROE more than you would care for ROA because your investment is all in the common equity and nothing else, whereas the total assets include not just equity, but also other kinds of liabilities and debt, which does not concern the shareholders. The last category here is called market value ratios. And the market value ratios incorporate the stock price, which changes very fast and very frequent. And it also tells you the risks embedded in the company's market price. Let's say the market price for a stock is $12.17, and you can calculate the earning per share based on net income divided by the shares outstanding. And you know net income is for the entire company for the whole year divided by shares outstanding. That is telling you the earnings at a per share level. You can have this PE ratio or price earning ratio by using the price per share, the stock price at that moment, divided by earning per share to have this ratio, PE ratio. In the United States, the PE ratio normally range from 20 to 30, so the PE ratio cannot be too high. If the PE ratio is too high, that means the market is overvalued. Then people would try to sell and cash out their investments. If PE ratio is too low, that means the market is undervalued. Then people would invest more money in the undervalued assets until the price back to normal again. Market-based ratios like the cash flow per share, cash flows from the previous chapter is net income added by depreciation. So I'm not gonna go over each of these ratios because we know what they're used for, and when they come up with the formula, we're not surprised and we know how to calculate these ratios. But I do want you to know what this ratio is. It's called a market to book ratio, and it is a very important indicator for stock prices. The market book ratio can be measured at the entire firm level or at the per share level. So the market price per share is from the stock market, either New York Stock Exchange or NASDAQ. And the stock price keeps changing very fast, very frequently, and the frequency is super high. It can get to 200 nanoseconds. And the book value, on the other hand side, does not adjust quite often. The book value at most would change 4 times a year, and each time when the quarterly report is released. So the book value is from the financial statements, which come out 4 times a year. So there is a inconsistency between the market value and book value. The market value, the price, changes all the time, and the price basically is determined by the cash flows of the firm and also the risk of the stock prices. And we will learn how the stock price is determined in our later chapter. So here are the major important ratios, and I want you guys to know what P/E ratio is and what market to book ratio is. And you know that the size, the market size, together with the market to book ratio, explains a lot of the stock returns in the United States. And that was a founding by Dr. Eugene Fama and Dr. Kenneth French back in the 90s, which helped them win the Nobel Economic Prize. We can also construct these common size balance sheets and a common size income statement. Instead of using dollar figures, we use the percent. So for the common size balance sheet, the base is your total assets, and every other things would be a percent of the total assets. So the calculation per se is pretty easy. And for the liability side, you know, the total liabilities and equity equal to total assets, and still that's the base for all the other numbers in this side. And for the income statement, the base is changed to sales, and every other things would be a percentage of the sales. And we're gonna use this common size method to adjust the size effect, because some large companies like Apple, they could have billions of total assets, billions of sales, and some small tech firms, they could just run in hundreds of thousands of dollars. So if you compare the dollar figures at different magnitude, it's not an apple-to-apple comparison unless you switch everything into percentage and compare them in the same scale. The next one is called the Du-Bois equation. So as I mentioned earlier, ROE, return on equity, is net income divided by total common equity. As a stock investor, you care that ROE is outmost, because net income is the earning to the stock investors, and your investment is in the common equity, which is the denominator of the ROE. And the Du-Bois equation basically further divide the ROE into 3 components. One is gross profit margin, another is assets turnover ratio, and the last one is equity multiplier, which is a debt ratio. So you can see each of the 3 ratios belongs to a different category: profitability, efficiency, and debt level. So in order to boost the ROE, the firm can either increase its profitability or increase its efficiency, or simply increase its debt level. And when we do the ratio analysis, there are some limitations and potential problems, because sometimes when we do the comparison against the industry, it is it is difficult when the firm have different divisions or segments. For example, if you look at Walt Disney, it has many segments. The primary business here is media, because Disney produces films and videos, and it also produces computer software and the toys, games, and also they run the theme parks. So they have different segments, and it's very hard to find a benchmark company to compare with. On the other hand side, for a single segment firm like a Molson Coors Brewing Company, they produce beers. they only have one line of a business, so it's very easy to compare. So that's one of the problems here. And some seasonal factors can distort ratios. For example, like the airline company, they charge higher price of air tickets during the summer and Christmas, and so that's when they have a higher revenue. And if you compare airline companies with other companies, then that's not quite a fair comparison. And there could also be a window dressing because all the ratios can be manipulated by the managers. There is also different accounting procedural that could distort the result just because some other companies in Canada or UK are having different accounting methods.